The income tax, after it was voted in with the change of the Constitution, people had a problem. What is it we're going to tax under the income tax? What is income? The law says income from whatever source, but it didn't say what income was. So the professors had to get together and the accountants had to get together, and what is it we're going to call income? The most famous definition of income, and the one that is sort of the theoretical underpinning of what you get in public finance courses and to some extent in the law schools, is the HAIG-SIMONS definition of income. Robert Haig and Henry Simons, Yale and the University of Chicago in the 1940s. They want to tax the change in your ability to spend. The concept is ability to pay. So your income this year is the change in your potential spending power. It's your current earnings, some of which you will consume and some of which you will save, and it's any change in the value of the assets you've already been holding from previous savings. If you get a capital gain or capital loss, it will affect it. Now that happens whether you actually sell the asset or not. Your ability to save has been altered. Your ability to spend has been altered, even if you don't recognize the gain or the loss. They would like to have taxed the gains on accrual, but it was so difficult to do, they just settled for taxing it when you finally sold the asset off. So it's the rise in the value of the assets as well as your current earnings from labor, rent, interest, dividends, profits, whatever. Now, in determining your profit, you have to take your revenue and you have to subtract your costs, don't you? Because the profit is the difference between them. In determining the profit, they decided they would recommend long depreciation lives under a schedule they called economic depreciation. They did not, however, want to see a double tax on the corporate sector. But we had it anyway because Congress wanted to make sure that as the earnings were retained and not paid out, they still got their revenue sooner rather than later. So they put the tax on the corporate level to capture the tax on the retained earnings. And then they also applied it to the dividend payout, which wasn't deductible. So they were double dipping. So your predecessors were as eager to get revenue as your current sitting members. The common income tax. We have a mixture of income and consumption features in the current income tax. We do not have a pure tax system. The current tax system does tax labor, income, rent, interest, dividends, and profits. But we defer the tax on the capital gains because it's too hard to measure otherwise. And we often give it a lower rate. If you bunch the gain into 1 year that you've accumulated over many, many years when you would have been in a lower tax bracket if you had taken it in pieces and you get into a graduated system and we dump the whole thing into your top tax rate, we can really give you a very hard time. And another rationale is that, part of the gain is due to inflation, so maybe we shouldn't tax it fully. Those are legal arguments. The economic argument is a different one. What is the value of a $100 bond paying an interest coupon of 5% a year when interest rates are in fact at 5%? $100. If I take that stream of earnings and I discount that whole stream of earnings back to the present, I'm going to get something equal to $100. What if interest rates have doubled to 10% in the meanwhile? What's the value of that old 5% coupon? Less. When I discount a $5 a year interest stream at a 10% discount rate, I'm going to get, if that bond is a perpetuity, I'm going to get a value of only about $50. The price of the bond is going to fall because the interest rate went up, okay? All right. Well, the point is that the value of an asset is the present value of its future earnings after tax discounted to now. If those earnings go up because the company I hold shares in is about to unexpectedly invent a new cure for something or build a better mousetrap, everybody's going to say, oh, its earnings are going to go up in the future. Let's bid up the price of the stock. If the earnings do go up, they're going to be taxed under the corporate income tax. If you also tax the increase in the price of the stock, you're double taxing the increase in the future income. Now, the same thing holds true for a small business that isn't a corporation. If it starts doing something really well and its prospects improve greatly, the owner could very well sell it for a higher amount of money than he could the year before, because the earnings are going to be higher. They're going to be taxed. If you tax the increase in the current price reflecting the future earnings, you're double taxing the future earnings. That should be the real reason for not taxing capital gains or taxing them at a low rate. That's not what you hear in the law schools, though. Anyway, the concept of the economic depreciation is also not honored at the moment. We have depreciation of assets with a certain amount of acceleration or with partial expensing compared to the very long lives under a so-called economic depreciation. We do that because it was too harsh and people weren't investing enough. And then we have, of course, the double tax on the corporate income, unless we do have the lower tax rate on the dividends. So we have a mixture of of consumption and income taxes. Now, we also have the pension arrangements, which partially offset that layer of tax on the saving that was the second layer of the double tax I showed you earlier. But limited amounts can be contributed. It's not on all savings. So it's a partial move from an income base to a neutral base, not a complete one. Now, a neutral tax system, which took away all those added layers of tax on the income saved as opposed to the income consumed, is sometimes called a consumption tax, sometimes called a cash flow tax, sometimes called a consumed income tax, changing the definition of income away from HAIG-SIMONS to this base that doesn't have the multiple layers in it. The key differences are you would defer all taxes on all saving. Everything would get IRA treatment, either Roth or regular, not just some saving. There'd be no limits on the contributions or when you can take it in or put it, or how much you could put in or when you had to take it out. All assets would be immediately expensed, and then any returns you got on those assets would be taxed. They'd be treated like an IRA. There'd be no double tax on the corporate income. It would be taxed either at the corporate end or at the shareholder end, but not both. And if you want full neutrality, you have to get rid of the estate and gift tax. We have a mixture. Well, in deciding between these two types of tax systems, you have to recognize that pure economic efficiency isn't the only thing going on here. We have a social safety net. We have some concerns about the distribution of income and wealth. Haig and Simon were growing up, were doing their thing in the 1930s and 40s, and you had the rise of fascism and communism. We had social unrest. We had the Depression. You don't want a society that is undergoing a great deal of unrest and upheaval. And Simon in particular felt the distribution of wealth was inappropriately tilted. We get this again now with Thomas Piketty and the current debate. Well, here's Henry Simons. The case for drastic progression in taxation, and he's talking about the graduated tax rates now, must be rested on the case against inequality, on the ethical or aesthetic judgment that the prevailing distribution of wealth and income reveals a degree and or kind of inequity which is distinctly evil or unlovely. The degree of progression in the tax system may also affect production and the size of the national income available for distribution. In fact, it is reasonable to expect that every gain through taxation in better distribution will be accompanied by some loss in production. He's admitting that there's a cost in addition to the benefit. That is a judgment call. It is a political call. It has nothing to do with the economist saying this is good or this or bad. We can try to tell you what the cost might be, but you have to decide how much of this you want to do. If reduction in the degree of inequality is a good, then the optimum degree of all progressions must involve a distinctly adverse effect upon the size of the national income. With respect to capital accumulation, the consequences are certain to be significantly adverse. The net effect will be increased consumption, hardly admits a doubt. The contention here is not that there should be correction of the effects of extreme progression upon saving, but that government saving, rather than modification of the progression, is the appropriate method for effecting that correction, if such correction is to be made. Translation, we can make up for the collapse in private saving by having government run surpluses. When was the last time you did that very often? I mean, really? And if you did run the surpluses, but the higher tax rates that you have imposed have discouraged the investment by the private sector, just cramming money into the credit markets when people don't want to borrow it and don't want to invest it won't cure the problem. Alfred Marshall, this was the 8th edition, 1920. I think he began writing his textbook in 1890. But he said, there is a general agreement that a system of taxation should be adjusted by more or less steep graduation to people's incomes, or better still, to their expenditures, for that part of a man's income which he saves contributes again to the exchequer, he was British, until it is consumed by expenditure. He said, don't have a progressive income tax, have a progressive consumption tax. Don't interfere with the saving consumption choice. You can still get progressivity by having a graduated rate structure, but do it on the neutral tax base instead of the income tax base. He lost the argument. So the philosophy behind the income tax, its aim is to redistribute wealth. The multiple layers of tax on income from capital are designed to aid redistribution and also for the graduated tax rates. Tax is based on ability to pay, and the definition of income is geared toward that result. It is defined as the change in net worth in the time period, new earnings plus change in the value of assets. Saving and the returns on saving are both taxable with no deferral, no IRA, no pension. Capital gains would be taxed as accrued. The portion of the return that only equals the time value of money is still considered taxable income. Time value is not regarded as a cost of saving. Locking up your money doesn't count. Economic depreciation limits. Economic depreciation. If you have a machine that you bought for $100 and you know you're going to have to replace it in 5 years, and let's say that it's going to wear out or become obsolete at roughly $20 a year. So next year you could turn around and sell it for $80. If you wait 2 years, you could only get $60 for it. And at the end of its lifetime, it's worth nothing. You could, in theory, sell the machine next year and get $80 back out of your 100. So Simon says you only get a write-off of $20 because your ability to pay is still partly there in the machine. That's the theory behind economic depreciation. Now, we do not know how fast capital wears out. And in our tax code, we have a lathe in one industry given one life and a lathe in another industry given a different life. We have all kinds of weirdness going on in the depreciation schedules, and we don't really know how fast things wear out. So it's all guesswork. You can't measure it. But that's the theory behind it. In the neutral tax concept, however, if I've locked up that $100 in the machine today, I can't use the $100 for anything else. I can't buy a fifth of the machine every year. I have to buy it all at once. And while my money is locked up there, I am not earning interest on it anywhere else. I can't use it anywhere else. The opportunity cost of the money that we heard about from Russ Sobel in week 1 is the $100 on the day I buy the machine. That's the alternative notion, and that's the rationale for expensing. So you see there's a tension there that has to be decided based on what it is you're trying to accomplish, not so much as there being some absolutely right way of doing something regardless of your principles. The philosophy behind the saving consumption neutral tax is to tax all uses of income equally to minimize those deadweight losses, not the unequally situation where the deadweight loss in some areas is higher than in others. The aim is not to distort the choice between saving and consumption. The multiple layers of tax on income from capital are specifically avoided. You can impose graduated tax rates on the saving consumption neutral base, although they do discriminate against higher producing individuals. The definition of income in that system is geared toward neutrality, revenue less cost of earning revenue, and included in the cost is saving. It's a net cost of earning revenue. You get to defer it. And in the inside buildups are deferred but taxed later. Capital gains are not taxed per se. You deduct the price that you paid for the shares. When you sell the shares, you pay tax on the whole sales product, including the capital gain that's embedded in it. Capital outlays are immediately expensed, not depreciated, because the opportunity cost is up front. We hear a lot of things about trading off tax expenditures for lower rates these days. The trouble is the tax expenditures depend on what you consider to be a normal tax system. If you believe in HAIG-SIMONS, expensing is a tax expenditure. If you believe in the neutral tax base, it's normal, and anything less than full expensing is a negative tax expenditure. It's actually being taxed too heavily. So in the saving consumption tax system, we would not consider pensions or expensing to be tax expenditures. We consider them to be normal, and the corporate tax itself would be a negative tax expenditure. Now, there are some things that are tax expenditures under every system, whether you're talking about HAIG-SIMONS or you're talking about neutral tax system, and these are the things we simply don't tax. These are the complete exclusions, and the biggest one is the healthcare exclusion, employer-provided healthcare exclusion. There's a good discussion of this in the tax expenditure chapter in the 2009 budget of the United States in the special analysis section. It goes over, these are the things that are tax expenditures under the broad-based income tax, per usual definition. These are the things that are tax expenditures under the sort of mixed hybrid that we've kind of forgiven certain things for. And these are the tax expenditures under a neutral or savings, or a consumption-based tax. They didn't get it all right, but they came fairly close, and it's a very good discussion. Unfortunately, it is deadly dull. So save it for when you're really having trouble sleeping. So when you go to the tax expenditure list to find something to pay for tax reform, you have to watch out. First of all, it's not a revenue estimate, because if you took away a tax expenditure, the joint tax people measured the amount as if it had never existed. What would the tax system look like if this hadn't been around? And of course, in the transition from one state to another, you're going to get a very different revenue estimate over the budget window. You are going to get an economic effect from some of these things. If you take away expensing or accelerated depreciation, you're going to have a big hit to the economy. The dynamic revenue estimate has to be very different from the static. And so for all these reasons, you have to be very careful about dipping into this list as a place to look for tax reform. What you really have to think about is this. We hear lower the base and lower the tax rate and broaden the base. That is one way of putting it. The other way is broaden the tax base and lower the tax rate. Well, wait a minute. Meaning one, lower the rate, grow the economy, everybody's income goes up, and the government gets more money, and that gives you a bigger tax base because the GDP is higher. That's fine. Meaning two, throw more things into the tax base so the government gets more of the existing income in tax, and then lower the rate on the bigger base to aid growth. That means you haven't got a definition of income in mind. If you can just throw things into the tax base, you haven't got a definition of income in mind. The one is the one you got. If you want to go to the income base, you do one sort of thing. If you want to go to the neutral base, you do another sort of thing. You have to know where you're trying to go before you decide whether to put something in the base or not.